Have you ever been left scratching your head when a big news headline was met with the complete opposite market reaction than logic would suggest? Well, I'm willing to bet you have. In fact, here I am in early July of 2025. One might say this has been the rule of the day for much of this year. We've had dramatic headlines and markets have done dramatically unexpected things. If there's one thing that financial markets excel at, it's in doing their very best to confuse investors relative to what should happen. And make no mistake, news headlines are constantly feeding our brains with expectations of what should happen. This has really been this way since the beginning of time, certainly of modern times. Headlines and media have been unhelpful influences, and especially in today's social media fueled environment, the dynamic is as tricky as ever. Hello, everybody. I'm John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. I'm also a certified financial planner, and I and the team here at New Harbor have been helping everyday clients to navigate the vagaries of financial markets for about a quarter century. That task is challenging enough, but it's made even more so by the fire hose of headlines and media spin that often serve only to confuse and misdirect investors. Trust me, we're not perfect, and we've made every mistake in the book over the course of our careers. We've been influenced by news headlines and media, and we've also learned a lot. So today, I'm here to provide you with some practical insights to help you become aware of the myriad ways in which news headlines can negatively impact your investment results without you even realizing it. Later on in this video, I'll share some actionable tips and strategies that you can use to help gain control of your investing behavior and to be better able to extract useful signals from all the noise. So stick around to the very end because these very important takeaways I think will be helpful to you. The first thing I want to point out is that the economic data that is constantly being reported on by the news, these data points are not all created equal. I want to talk about the concept of leading, coincident, and lagging economic indicators. To help do that, I want to bring up a graphic put together by the visual capitalist. So there are three types of indicators: leading, the orange one. These are indicators that give a sign of likely what's ahead in the market in the economy. So they're leading. Then there's coincident indicators. These are indicators that are giving a good signal about what's currently going on, the current conditions of the economy or the market. And then there are what we call lagging indicators. These are affectionately also known as rear view mirror indicators. And arguably, these are the least helpful because they cause folks to literally live in the past instead of what's coming ahead. So for example, in the leading category, we have consumer confidence index. Now, this is also what I would call a contrarian indicator. So this goes back over a period of time, and the dark red areas here are recessions. And what you notice here is the consumer confidence tends to be lowest right after a recession. And it's in the months and weeks that follow and years that follow where the markets and the economy tend to improve. And so too with that does consumer sentiment. Scrolling down here, the S&P 500, the market, in other words, is itself a leading indicator. Why is this? Because markets tend to look forward. There's a saying that markets look ahead and look past all the trouble spots and look to the bright side that eventually is coming around. In terms of coincident indicators, let's look at things like GDP and personal income. You'll notice here that these bars show that these indicators tend to go negative right in the same kind of periods where recessions are occurring. So these are usually a pretty good pulse on what's currently happening. And then let's look at lagging indicators. And one that is probably the most tricky is unemployment. The unemployment rate, understandably, is a very sentimental indicator. Folks, when they either have lost their job or they see those around them have lost their job and unemployment is at very high levels, it's understandable that they would be pessimistic. But in actuality, the market and the economy has shown that when unemployment rates are at their worst, it's usually the very start of an economic rebound and market rebound. There's a saying that it gets darkest before the light, and that's certainly the case with unemployment and other lagging indicators like that. So the next thing I want to point out is that oftentimes different data points that are purportedly measuring the same thing can be wildly different. Let's look to a couple examples just in the last handful of months. So back in April of 2025, we had a pretty volatile market. The stock market dropped. At one point, it was registering a technical bear market on the year, down over 20% from the high. What we saw there is that investor sentiment was about as pessimistic as we ever see. And I'm talking about the likes of negative sentiment that we've seen at the major bear market bottoms of like the great financial crisis and the tech bubble. Both instances, the markets dropped over 50% or more. And to see that level of negative sentiment, even though the markets were only down about 20%, the sentiment got really, really bad. However, if you look at the actual investor behavior, it was completely at odds with that. If you look at some of the hard data showing what retail investors were doing in April, they were buying dips, they were loading up on levered long ETFs. Not the kind of thing you'd see when people are throwing in the towel. It was actually very over bullish sentiment in that regard, the actual behavior. So these are two data points that are meant to measure the same thing, but speaking wildly different realities. Fast forward to just last week, we got the June jobs report. The first one was by ADP, which is a large payroll company. They put out the ADP report, private payroll report. It showed a big downside miss, a loss of something like 37,000 jobs. And this was way lower than anybody had been anticipated, and the first negative or loss of jobs, I think, going back to 2023. So a big, big negative report. The very next day, the Bureau of Labor Statistics put out their monthly job report, and that was unexpectedly positive. So we have these two data points measuring the same thing, giving completely different reports. We're very disadvantaged that even though similar data purportedly measuring the same thing can give wildly different conclusions. The other thing is that many data points are of very suspicious quality. Many of the data points that get reported on by the news are what we call soft data. In other words, they're oftentimes developed through things like surveys. Now, there's lots of analysis that go into these surveys, but one of the big takeaways is that over time, these surveys have been subject to lesser and lesser participation. So the universe of the survey is arguably becoming less and less relevant. Some of these data points are very noisy. Month to month, these things change. So for example, like inflation reports month to month can be very volatile. Job reports month to month can be very volatile. And a lot of these data points even can be subject by design to retroactive revisions. So for example, GDP numbers, there's what's called the early release, and then there's like 2 or 3 or I think even 4 subsequent revisions that it's many months after the quarter in question where the data series is finalized. With many economic data points, the value is oftentimes more in the trend over several months than in the instantaneous report in any given month. So all to say there are tons of landmines into the very data that the news headlines do such a remarkably persistent job in trying to report to us. The next thing I want to talk about is headlines as a contrarian indicator. And this is very much a kind of a symptom we see at major extremes in markets. When headlines are being pushed with the loudest volume, or when everybody seems to notice a certain headline, it's oftentimes more than not a sign that markets are likely to do the opposite of what that headline is suggesting. One of my very favorite contrarian indicators in this regard is that of magazine covers, as they are often the most seductive of all media tools. They oftentimes have very provocative pictures and subtitles that are really meant to lure investors in and have them, quote unquote, take action. Again, we think oftentimes very unhelpfully. Okay, here's a Newsweek cover that goes back to September 9th of 1974. And I've shown a chart of the S&P 500 in the years leading up to and after that headline cover. Notice the big bad bear. And in fact, 1973-74, as you can see, the market had a very significant downdraft. This was a very nasty bear market, the 73-74, actually 2 back-to-back negative years in the stock market. A cover like this plays very much into the psychology of people at the time. But notice what happened. That was almost within a few weeks or a few months of the ultimate low in 74, and we had a very powerful rebound in the stock market. Not quite a doubling, but close. This was a very unhelpful magazine cover at that time. Let's fast forward to August 12th, 1979. Business Week, the headline note on the cover, "The Death of Equities, How Inflation is Destroying the Stock Market." Here again, we see that this cover, it was very appropriate in the sense that the 70s were a horrible time for most financial assets. The stock market, I just talked about the 73-74 bear market. There were 2 or 3 pretty large bear markets and very volatile stock market in the 70s. In fact, if you look at the late 60s to the early 80s, the stock market pretty much went nowhere on a nominal basis and even lost money on an inflation adjusted basis. So it's understandable that we'd see magazine covers of this sort. But look what happened in the market afterwards. We had a nearly 2-decade massive bull market that culminated in the tech bubble, but nonetheless, it was a horribly mistimed article in terms of the sentiment and what investors should have been doing. Speaking of the tech bubble, let's fast forward to September 27, 1999. This time cover getrich.com, secrets of the new Silicon Valley. Well, if you were one of those investors that up until that point hadn't been jumping into the dot-com bubble, well, didn't you feel foolish? And, that caused a lot of people to jump into the tech bubble right before it topped in early 2000 and dropped considerably. The NASDAQ, the tech-heavy NASDAQ, for example, dropped over 80% peak to trough after its high in early 2000. So as you can see, magazine covers represent peak media attention and oftentimes coincide with peak investor emotion. When everybody's talking about something, an opportunity such that it's literally the cover story of magazines, it's usually sign that things are going to go the other way. If it's overly bullish headline, pretty good sign that we're getting close to a top that will likely result in a multi-month, if not multi-year reversal. And the opposite, when things are really, really pessimistic, that's usually the time where one should be more embracing a risk, because it comes back to the old adage, an old cliche: buy the rumor, sell the news. By the time something becomes major news, the opportunity is often already passed. So the next thing I want to talk about is the media industry itself and the biases and the programmatic systems in there that are really meant to not really help us, but to mislead us and to monetize advertising dollars and things like that. And it's really important to be aware of these things so that you can be much more in tune with how they're affecting your life financially and otherwise. The first thing I want to talk about is negativity bias. This is something we all suffer from, and it's the subject of a lot of academic research. Things like prospect theory talk about this, where quite simply, we humans are wired psychologically to be more concerned about what can go wrong than what can go right. In other words, we're more concerned about losing big than gaining big. And the Harvard Shorenstein Center found that the news coverage is disproportionately negative compared to actual data. Why is this? Because bad news gets more clicks. So news outlets and media outlets amplify it. It's quite that simple. Secondly, the media industry itself has to be a 24-hour content machine. They have to create consumers of media. They've got advertisers that rely on those media channels to get their advertising out and get as many eyeballs. And how do they do that? They create this content 24 hours a day. Financial news channels are constantly trying to fill every hour with something provocative, turning what would otherwise be minor market moves on economic data that doesn't really matter into urgent breaking news with all kinds of flashy graphics. The third thing, and this is probably commonsensical, there's a tremendous amount of political and corporate bias across media outlets. This here is a study that was done through the Wharton School at UPenn, and it basically validates with an actual data under framework, an empirical framework, the hunch that many of us have that various news channels are politically biased. This actually used large language model AI tools to mine literally thousands of articles and content and kind of lump it into kind of Democratic leaning or Republican leaning. And you can see some channels, some media outlets like the Huffington Post, the vast majority of the content leans Democratic. Contrast that with Fox News and Breitbart, the vast majority lean Republican. This isn't particularly newsworthy. I think most people that turn on the news and they have their favorite news channels probably know this in their guts, but this is an empirical data study. They actually put empirical data support to that gut feel. The next thing is that back in 1983, there were something like 50 companies that comprised the top 90% of all the media out there. By 2011, only 6 companies owned 90% of the media. So you see some of these big household names: NBC, Disney, CBS, Time Warner, so on and so forth, and all their various media properties. They cover everything from traditional news to sports to entertainment to lifestyle, all these things. And you betcha there are corporate biases and messaging that flows through all these channels. Point being is there's tremendous concentration. All these companies have tremendous lobbying efforts on Capitol Hill. So to think that you're getting objective data through traditional media would be a big naive assumption. Then of course we have social media. Over the last decade or two, more recent years than that, especially now that we have a president who turns to Twitter and his own social media channel as the first ways to get executive announcements out, social media has become a huge influence on what we all see and what we all believe. Even there, though, there's tremendous bias. If you talk about like search engines or newsfeed bias. You type in keywords into a browser like Google. There have been documented studies that show there's bias in what gets delivered up as top hits. And that is different for different people. Sometimes it feeds into one's own browsing history, not by accident, but by design, because we consumers of news are exactly that. We're a product. If it's free, we are the product. A lot of opinions that seem to be gaining legitimacy out in social media are doing so not on their kind of accuracy or the robustness of their research, but based upon likes and shares, all driven by algorithms and things like that we have very little understanding of. And then there's downright fake news. More recently, the advances of AI have raised that concern to a heightened level. I recall, for example, during the recent bombing campaigns in Iran and Israel, but during the heat of that, there were some video footage that had every appearance of being live footage, but much of it was AI generated, showing these massive bomb blasts, for example, that weren't anything like what was going on. Point being is it's become very difficult to discern what is real and what is fake. The next thing I want to point out is that we can be our own worst enemy when it comes to digesting and acting on media news headlines. We all suffer from this thing called confirmation bias. I did a video several months ago about 5 hidden biases that we all fall victim to. And confirmation bias is probably best summed up by the famous Mark Twain quote. It ain't what you know that gets you in trouble. It's what you know for sure that just ain't so. What does that mean practically speaking? Well, we individuals, we seek out sources and data points that reinforce our informational, market, and political biases. We don't want to hear viewpoints that don't agree with our own, or assumptions or strong held beliefs. That's something that's really important to get in touch with. We here at New Harbor work very hard to challenge our own biases, because we have them, by just taking in more information, especially those that don't necessarily agree with our views. And now I really want to focus on practical tips and strategies that you can use to help protect yourself from being unduly swayed by these things. Okay, so the first thing I want to say is don't trust everything you hear or see. Be a healthy skeptic about everything, certainly when it comes to headlines about markets and the economy. And when you see extreme headlines, usually the more extreme, whether they're positive or negative, it should trigger in you a suspicion that we're closer to a beginning of a trend or the end of a trend. Extreme headlines usually mark endings, not beginnings. I'd like to suggest develop what I call a contrarian intuition. When everybody's talking about some theme, whether it's AI stocks or crypto or clean energy, that's usually when you want to be most cautious. Doesn't mean these things are not legitimate or not here to stay. It just means that they deserve some extra tire kicking or data analysis before jumping all in for sure. And rarely is it ever good to jump all in. But when these headlines get as provocative as they sometimes can, that's oftentimes when people want to do exactly that. I want to remind everybody that the market is forward-looking. I talked about how the market itself, the stock market itself, is one of the most clear examples of a leading indicator, something that's telling us where the future is likely to be. And this is because the market and the collective wisdom and assumptions of all its market participants tells us what the sum total of the buyers and sellers are thinking about the future. It's not a perfect indicator, but it's usually pretty good at predicting major trends that last many months, if not years. The market's always trying to figure out what's coming in next, not what's happened. Doesn't mean markets can get misguided, but the market's generally a pretty good forward indicator. The next strategy I want to encourage you to think about is always seek out multiple sources and perspectives, especially those that are at the other end of the political spectrum of yours, where you typically go. Or if you're bearish, seek out bullish counterparts, and vice versa. If you're bullish, seek out the bearish argument. Let those contrasting viewpoints gel in your intellect, and I guarantee you that usually there's something in the middle there that is the right answer, the right view, the right take, because the extremes oftentimes are blinded by what they don't know. For any given data point, seek out alternative indicators. I already talked about, for example, the different jobs data. Don't rely just on ADP. Don't rely just on BLS. Rely on both. And even more importantly, look at them over many months and discern trends, not one noisy month's data to the next. The next one is probably the most important bit of advice I have for you, and it's to bring it back to your own situation and goals. Prepare a financial plan, or if you've already done one, consult it frequently. Financial plan doesn't need to be anything too exotic or in-depth. It simply has to be a sanity check on where you are relative to your assets and what your goals are. Can those assets provide for what your near and longer term goals are likely to be? And certainly if you have a strong financial situation, don't take risk when things are risky if you don't need to. Don't try to keep up with the Joneses. I like to say, embrace JOMO, the joy of missing out rather than chase FOMO, the fear of missing out. And then finally, when it comes to investment process and discipline, use tools and processes that are meant to focus on what the market is telling us, not the media. So for example, focus on leading indicators over lagging indicators. I talked about some of those earlier on. We employ as a very central part of our investment strategy here at New Harbor what I'll broadly call technical analysis. Basically, technical analysis is simply, rather than focusing on bottom-up economic or fundamental data, technical analysis is grounded in the thesis that the price action itself of whether individual stocks or stock market indices or asset classes at the aggregate level, they embody the sum total of all market participants' collective information. So at the end of the day, all that matters in markets is whether buyers are more eager than sellers. That's quite literally as simple as things are. Now, it's very complicated and there's a lot of emotion and behavior that go into that. But technical analysis some of the tools that technical analysis bring us, things like relative strength, momentum, statistical extremities, and how stretched things are from uptrends or downtrends. These are tools that can absolutely provide context and value. Technical analysis tells us what is, not what should be. And so doing, they acknowledge the fact that markets are often irrational and act on emotion, not quote unquote reality. But I want to encourage or urge you to take a weight of the evidence approach. Don't rely on one single indicator. There are no on and off light switch indicators. If you think there are, I guarantee you that you will sooner or later be led astray, and those indicators will prove not to be as robust as they seem. So we look at a broad variety of data. Market breadth indicators, momentum indicators, contrarian indicators, sentiment indicators, all these things together allow us to begin to, from an empirical data standpoint, put together a picture of the likely emerging future. And just like a jigsaw puzzle, I often use this analogy, you don't need the completed jigsaw puzzle to determine with a pretty good degree of confidence, is the picture that is emerging, is it a serene pastoral scene, or is it a stormy sea? Some of these technical indicators that we use, when used together, can help to put together those puzzle pieces and see that picture start to emerge. I don't want to mince words. This is a full-time job doing these kinds of systematic processes and following data. If you don't have the time, skill, or desire, seek out a financial advisor or some other service, a newsletter service that uses these approaches and can distill the essence for you. So I hope you found today's video helpful. The key takeaway is this: successful investing requires looking beyond the headlines to understand what the market is really telling us. I invite you to share this video if you think folks around you might benefit from it. We're all subject to falling victim to the headlines. It's just being aware of how they can sway us in unhelpful ways is more than half the battle, in my opinion. I invite you to like this video, follow our channel, hit the little bell icon here that will alert you to any content we put out. We usually put out content every single week on a whole myriad of topics. First and foremost, hoping to educate and make you a more empowered investor and take some of the stress out of what otherwise can be very confounding markets. So I want to thank you for watching, and until next time, I want to wish you a wonderful day.